Peter, you say that this is a time for intelligent fortitude. What does that mean, and what is the opposite of that?
Well, good afternoon, everybody. So I have created over time, Tyler, just a set of guidelines for what I think investors really need going into an earnings season like this. You know, we all go in with our minds on fire, what we expect to do, but sometimes I think it's better to just have a set of guidelines. So, you know, the first question I ask is, should you even be here? Meaning, do you have the stomach to suffer through this earnings period? I mean, I think this earnings period is going to be tremendously changeable. You're going to have every kind of interpretation about what people are seeing for the next 6 months. So if you don't have a long-term horizon, I would say you probably shouldn't even be listening to earnings reports. So long-term meaning over a year. And then the second thing is with these companies, do pay attention to what they actually do rather than what they say. So as an example, you know, if a company says we're going to tighten our belts coming the next 6 months, well, okay, you can interpret that many ways. But if a company says we are ceasing our stock buybacks, then that's much more tangible. And that can give you a lot more, insight into what these companies are actually thinking. And, you know, I also say, don't hang on every word, Tyler. These companies, although we think they know more than we do, in this case, I'm not sure they do, simply because we're emerging from the most tumultuous period of a recovery. So those are some of the things I think will help us with intelligent investing. And I'm sure you know what the opposite of that could be.
Yeah. What you say, we're emerging from a recovery? I'm not understanding. Maybe I don't understand you.
No, recovery from COVID. I don't necessarily mean a market recovery. I mean that, you know, we tend to forget. We get all worked up about, how quickly this recovery is happening and whether or not it's happening. We saw last week, will the Fed raise? I mean, for 24 hours, we were actually thinking the Fed was going to raise 100 basis points, and now we're back to 75. I mean, these things are changing so rapidly, and investors are trying to hinge on every word. And I think sometimes it's self-defeating.
So take a chill pill here, right? Is really what you're saying.
Exactly.
Take a chill pill.
Yes.
If these earnings are making you nervous, you probably shouldn't be in this market in the first place. If you're that upset and in turmoil over it. So you have a couple of stocks I know you want to mention by way of a kind of barbelly approach that can soothe your nerves.
Yes, I think for those of us that want to stay invested and are optimists, and remember, I think, to be a successful investor, you have to have two things. You have to be a risk taker and you have to be an optimist. And those two skills are really, really in demand right now. So say you want to stay invested. One of the ways, but you're still kind of nervous about where the market is going to go. One of the ways to do this is to take a high beta stock and pair it with a low beta stock. And by beta, I just mean how responsive these companies are to a change in the S&P. So if the S&P sneezes, and one of these stocks gets pneumonia, or I guess I should commonly say now COVID, then that would be a high beta stock. So you compare these two, and as an example, I gave Caesars and Equinix. Caesars is a very high beta stock. If any of you have been watching that, and I own that stock, and it's been stomach churning. It's 3.5 times more volatile than the S&P 500. And then Equinix is actually 1/3 as volatile as the S&P 500. So you pair those together, you might be able to sleep a little bit better at night.
Shepard Smith here. Thanks for watching CNBC on YouTube.